On February 8, 2021, Tesla announced it had purchased $1.5 billion in Bitcoin and would accept it as payment for vehicles. The announcement sent Bitcoin's price up 15% and ignited a wave of corporate Bitcoin adoption announcements. Within months, companies from diverse industries, technology, mining, insurance, and sports franchises, had followed with their own Bitcoin balance sheet announcements. Then the reversal began. Tesla sold 75% of its Bitcoin in Q2 2022. The price collapse from $69,000 to under $20,000 created significant mark-to-market losses that flowed through corporate income statements under the accounting rules then in effect. By 2023, most corporate Bitcoin experiments had been wound down. But several, MicroStrategy, Block, Marathon Digital, held firm and demonstrated genuine strategic conviction. The difference between the companies that successfully incorporated Bitcoin into corporate treasury and those that failed is not investment acumen. It is governance, accounting preparation, and strategic clarity about why Bitcoin belongs on the balance sheet. Corporate treasury management has a clear primary objective: preserve the purchasing power of company cash reserves and ensure adequate liquidity for operational needs. Traditional corporate treasury holds cash, money market instruments, and short-duration investment-grade bonds, assets with minimal price volatility and guaranteed liquidity. Adding Bitcoin to corporate treasury introduces characteristics that conflict with every traditional treasury objective: high price volatility, no guaranteed return of principal, and accounting treatment that can create income statement volatility even without actual sales. Under GAAP accounting rules in effect through 2024, Bitcoin held by corporations was classified as an indefinite-lived intangible asset, meaning companies had to recognize impairment charges when Bitcoin fell below their carrying value, but could not recognize gains when it rose above cost. The FASB issued updated fair value accounting guidance effective January 2025, allowing companies to mark Bitcoin holdings to market symmetrically. This accounting change materially improved the corporate treasury case for Bitcoin. The corporate Bitcoin treasury data shows a bifurcation between committed strategic holders and opportunistic adopters. MicroStrategy has held its position steadily through all market cycles, growing from $250 million to $14 billion in Bitcoin holdings. Block, formerly Square, holds approximately 8,000 Bitcoin, a position it has maintained since 2020 with no sales. Marathon Digital and Riot Platforms hold Bitcoin as a direct result of their mining operations. Tesla's trajectory illustrates the opportunistic approach: bought $1.5 billion in February 2021, sold $936 million in Q2 2022 for a $140 million loss, then sold additional tranches until only approximately $184 million remained. The 2022 impairment charges across all corporate Bitcoin holders collectively exceeded $1.5 billion. Following the FASB fair value accounting update in 2025, new corporate Bitcoin treasury announcements accelerated significantly as the accounting obstacle was removed. The defining comparison in corporate Bitcoin treasury is between two fundamentally different strategic intents. The first is Bitcoin as reserve asset, the MicroStrategy and Block approach. Bitcoin is held as the primary treasury reserve, with the explicit thesis that it is a superior store of value to cash. Allocation sizes are meaningful relative to balance sheet. MicroStrategy holds Bitcoin worth multiples of its market cap. The second is Bitcoin as tactical speculative position, the Tesla approach, a time-bounded position in Bitcoin based on price momentum expectations, with an implicit exit plan when the trade no longer works. The risk profile and governance requirements are entirely different. Reserve asset strategies require board-level conviction, explicit accounting preparation, and multi-year holding horizons. Tactical speculative positions require trading risk management, exit strategy documentation, and clear position limits. Most corporate Bitcoin failures occurred because companies applied tactical speculative position governance to what they publicly described as a reserve asset strategy. Corporate Bitcoin treasury creates three categories of institutional risk that boards and CFOs must address explicitly. Balance sheet volatility risk is primary. Bitcoin's 70 to 80% bear market drawdowns translate directly to asset write-downs that impair reported equity and trigger banking covenant concerns. This requires explicit pre-approval from the board and potentially from lenders before Bitcoin is added to the balance sheet. Liquidity risk is the second concern. If a company needs to sell Bitcoin during a bear market to fund operations, it may realize significant losses at the worst possible time. Minimum cash reserve policies must be established before any Bitcoin allocation to prevent forced selling. Reputational and governance risk is third. Public companies that announce Bitcoin strategies and then reverse them face significant credibility damage with both shareholders and institutional analysts. Block, formerly Square, represents the most institutionally sophisticated small-cap corporate Bitcoin treasury strategy. In October 2020, Block announced a $50 million Bitcoin purchase, approximately 1% of total assets. CEO Jack Dorsey framed the allocation explicitly as a long-term reserve asset consistent with the company's mission to provide global economic empowerment through accessible financial tools. The position has never been sold. Block's approach differed from Tesla's in three important ways. The allocation was small enough to be immaterial to operational liquidity. The strategic thesis was clearly articulated and tied to the company's core mission, and the company never publicly committed to accepting Bitcoin as payment, which created an implied reversal narrative when Tesla reversed on Bitcoin payments. By Q1 2026, Block's Bitcoin position had grown to approximately $500 million in market value from its $50 million cost basis, a 10x return that has been additive to, rather than distracting from, the company's operating results. Companies considering Bitcoin treasury additions should follow a four-step governance framework that separates strategic intent from implementation details. Step 1 is thesis articulation. Define explicitly why Bitcoin belongs on this company's balance sheet. The thesis must be specific, mission-aligned, and durable through a multi-year bear market. Step 2 is size determination. Allocate only what the company can afford to mark down by 80% without triggering covenant violations, operational liquidity concerns, or material financial distress. For most companies, this is 1 to 5% of total assets. Step 3 is accounting and tax preparation. Engage auditors before announcement to establish treatment under FASB ASU 2023-2008, address tax implications of Bitcoin sales, and confirm banking covenant language doesn't preclude the allocation. Step 4 is board and investor communication. Ensure the board has approved the strategy with a multi-year holding commitment documented in minutes, and prepare investor communication that sets realistic expectations about balance sheet volatility. 3 corporate Bitcoin treasury mistakes are consistent across failed programs. First, adding Bitcoin without auditor pre-approval on accounting treatment. The impairment charges that resulted from pre-2025 GAAP treatment caught many CFOs off guard and created earnings volatility that had not been communicated to investors. Second, sizing the position without stress testing operational liquidity at an 80% drawdown. Companies that needed to sell Bitcoin in 2022 to fund operations locked in maximum losses. Third, making public commitments, Bitcoin as a payment method, long-term holding statements, without genuine board-level conviction, creating a credibility problem when market conditions forced a reversal. Corporate Bitcoin treasury is a legitimate strategy when executed with genuine conviction, appropriate sizing, and proper governance infrastructure. The FASB fair value accounting change in 2025 removed the most significant accounting obstacle. The remaining requirements are clarity of purpose, realistic board expectations about volatility, and position sizing that survives the worst historical drawdown without threatening operational solvency. Corporate Bitcoin treasury is no longer experimental. It's a documented playbook with clear success conditions and failure modes. Understanding the governance requirements is essential before any board vote. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.